One blue chip stock has produced a 600% return over the last 20 years, 6 times your money, and nearly double the return on the overall stock market. More than that, it's one of the best stocks to buy to protect your money in a recession. Hey Bowtie Nation, Joseph Hogue here with the third in what is becoming the most popular series on the channel, our Just One Stock videos. If you could invest in only one stock in different themes, which should it be? We're going to cover all the strategies here, from value to growth, tech stocks, and by the end of the series, you'll have a portfolio of the very best stocks to buy. So look for the link to the full playlist in the video description below. First though, if you want to see the stocks I'm buying and holding no matter what the market does, my forever stocks, look for the link I'll leave in the description. It's a special report I put together with the Motley Fool to highlight the best long-term stocks to buy right now. It's totally free, no obligation, so click through the link and get your free report. We talked about why investors need to find those best stocks to buy in our first video, how even with the market down 20% so far this year, that 150 stocks in the S&P 500 are posting gains and 42 of them are up more than 20%. Nation, you need to know how to find those stocks that are going to outperform for your portfolio. That's why I don't want to just reveal that one best blue chip stock to buy immediately. I want to show you how to find these and give you some ideas first. So let's start with a few of the best blue chip stocks to watch, the ones that almost made that top spot. Then I'm going to show you exactly what to look for in these and reveal that top pick. First on our list of blue chip stocks is one of my favorite long-term buys, $171 billion Salesforce Inc., ticker CRM. Now, Salesforce is unique from the other blue chips on the list because it leans more towards that tech and growth stock side, but it also has the size and innovation to make it a leader in so many segments. Really the biggest themes that are going to change our world over the next decade, including AI, remote work, cloud, and data across an addressable market CRM estimates at $248 billion. Salesforce controls nearly 20% of the global market for customer relationship management software and services. That's 4 times the next closest competitor, Oracle, with just 4.8% share. And here, what I think makes Salesforce more of a blue chip company than a growth stock is its revenue history. It's booked long-term revenue growth of 26% since 2014 that has been surprisingly consistent. While most growth companies see a burst of growth that quickly slows, Salesforce continuously finds new services and new customers to keep up that growth. Now, while Salesforce has been aggressive in an acquisition strategy over the last few years, I don't think it's the kind of problem that we're going to talk about later. Long-term debt is up to $13.3 billion, but only 24% on a debt-to-equity basis. And the company has doubled its cash on hand over the last 3 years to $10.5 billion, so plenty of financial flexibility. The shares are down 45% from the peak on that sell-off in growth stocks, but analysts have an average target of $240 a share over the next year, nearly 40% upside, and this is one of my favorite buy and hold blue chips. Of all the investing themes we'll cover in our one stock series, blue chips are probably the most misunderstood, but also one of the most important for your portfolio right now. Blue chip companies are those mega cap companies worth tens of billions of dollars, the most recognizable brands on earth, and with the most established businesses. Now, these are companies with economies of scale that give them profit advantages over their competitors and brands that everyone knows. And this all acts to make these blue chip companies super resilient in any kind of economy. In fact, often we see these companies build market share as those smaller competitors struggle in a recession. It makes right now the perfect time to be adding some blue chip stocks to your portfolio and why I wanted to make this video third in our series. Even if that broader stock market falls and drags down the blue chips down with it, they're going to be insulated from the worst of the crash and are going to help protect your portfolio until stocks head higher. Our next blue chip is $284 billion drug maker Pfizer Inc., ticker PFE, with not only a strong blue chip status, but also paying a 3.1% dividend as well. Pfizer has a worldwide reach with 1.4 billion patients and doubled its sales during the pandemic. And the company is expected to post 26% sales growth this year before that falls 21% next year just on a drop in vaccine demand. But this company is a leader in drug innovation, especially in the new mRNA technology. The new methodology could spark breakthroughs not just in vaccines, but across diseases and medicine. Pfizer always has a full pipeline of new drugs and launched 13 new clinical studies last year, ensuring that even as demand for some vaccines and drugs fall, new ones are always there to take its place. More impressive, though, is that the company has been able to do all of this and been able to keep its operating margin consistently above 25%. That's even as the need to spend billions in research and drug development and has been able to grow that without adding billions to debt. Pfizer's debt-to-equity ratio is just 44% versus competitors like Merck with a 77% of its capital structure in debt. Analysts like Pfizer up to an average target of $57 a share over the next year, which is only about 12% higher, but this one is one that's going to produce those consistent returns for decades. And we're just getting started, but I'm not about just telling you to buy a list of stocks. I want to show you exactly what to look for in blue chip investing, because how you look at these is going to be different from other stocks like growth or dividends. And the first thing to narrow your list of blue chip stocks is just making sure it fits that definition of size and financial scale. Now, I would start with only stocks at a market capitalization, so the total value of all the shares of at least $50 billion. Now that's going to cut your list of stocks you need to research and make sure you're only looking at the biggest powerhouses in the market. Like all stocks, I'm also looking for higher sales growth and a stronger operating margin versus competitors. And sales growth is usually going to be slower for blue chip companies just by nature of their size. It's not as easy to grow a $200 billion company at 20% as it is a $1 billion startup, but you still want to see that sales growth that's competitive. That said, blue chips should outperform on an operating margin, that operating income divided by sales, to prove that they're using their economies of scale to be more efficient than others. And remember, whenever you're comparing sales growth or operating margin or really any of these fundamentals, you want to do that with companies in the same industry or sector to get that fair comparison. It just wouldn't make sense to compare sales growth for a beverage company against that of a software tech company. The natural rate of growth just isn't comparable between the two industries. Now, these last two are the most important factors that you want to watch for when looking at these blue chip stocks to buy. First is the company's recent innovations in product and how well it's keeping up with changes. Nation, this is how blue chip companies die. Management gets arrogant, thinking it has that dominant product, and they stop innovating. Pretty soon, a startup comes along that completely changes features on the product or how it's delivered, and that makes the giant of the industry obsolete. We saw this with the BlackBerry, which back when I worked venture capital, even the coffee runners had BlackBerries, but the company failed to innovate when smartphones took over. We've seen it in media, all the magazines and the newspaper companies that have failed to innovate into the online era. Last factor, and we'll get back to our stock list, and while debt is generally less important for a blue chip company, another death risk is that debt-fueled acquisition strategy. You see, a lot of these blue chip companies will see their sales growth slow and think the answer is just to buy growth through buying other companies. The perfect example of this is AT&T's acquisition of First DirecTV and then Time Warner for tens of billions of dollars. Now, the problem is buying growth is no excuse for management that can't innovate, and these acquisitions never turn out as well as expected. In the 10 years leading up to that change in strategy this year, shares of AT&T have lagged the market by more than 260%, but because the company had borrowed hundreds of billions to fund those bad acquisitions that went nowhere. Nation, I realize this is deeper analysis than just looking at the stock chart and investing in what's going up, but this is what you need to be doing to stay ahead of the market and really find those best stocks to buy. Our smallest company on the list is still a $52 billion giant in healthcare, HCA Healthcare, ticker HCA. I really like healthcare as a long-term trend play as well as protection through the stock crash. HCA has a wide mix of businesses and facilities and services, two segments of healthcare that don't seem to be in the crosshairs of regulators for prices, not quite as much as drug makers or insurers. The company ranks first or second by market share in 27 of its 37 markets for more than a quarter of the healthcare enterprise market, so a solid leadership position in a growing market. Sales have grown at a 7.9% annual pace over the last 3 years, and the company has improved its operating margin by 2% to 16.5% last year. So not only is it growing revenue, but it's becoming more profitable to grow earnings faster. Analysts have an average target of $228 per share, or about 29% higher from here, and 55% to that top target. It's interesting how this next stock just keeps on coming up in different themes. $234 billion PepsiCo Inc., ticker PEP. Now, I highlighted Pepsi recently in a video on stocks beating the market, with its 5.3% gain this year against that 20% crash in the S&P 500. The company also came up in a dividends video not too long ago with its 2.8% yield and a payment that's grown by 8% annually for more than a decade. And I've got to admit, I do like the taste of Coca-Cola better, but I've got to go with Pepsi's fundamentals as an investment. The company books just over half its revenue in snacks, where it's the global leader, and the rest in beverages, so I think it has better diversification than Coke. Now, you might think there's not much innovation that can be done in the beverage industry, but Pepsi is always transforming the space. Right now, with ideas in zero sugar sugar beverage, in the coffee and energy vertical, and in nutritious snacking. It's also using data analytics and digitalization to drive efficiency and reduce supply chain lag. The company increased its 2-year revenue growth to 6.9% last year, a solid number for an older industry like beverage, and shares trade cheaply for 2.9 times on a price-to-sales basis, versus 6.7 times sales for shares of Coke. Now, one point that does make me pause here is the high level of debt, 225% on a debt-to-equity ratio for Pepsi. Coca-Cola has 157% debt to equity, so they're both pretty high, but cash flow is so stable in these that I don't think it's as much an issue as with other companies. The average analyst target is only 6% higher to $180 a share, but this is one of the most consistent blue chips out there and is going to help protect your portfolio through a recession. Now, I'll reveal that best blue chip stock to buy next, but I want to get your opinion on this as well. Scroll down and let me know in the comments if you think one of the runner-up blue chips should have been the top pick, or if you're watching a different stock in the category. And my top pick for best blue chip stock is kind of cheating here with $624 billion Berkshire Hathaway, ticker BRKB. Okay, so this is more of a fund than a stock, right? With a stock portfolio of more than 50 companies and a holding company for 20 plus more, you're getting the kind of diversification you usually need to buy an ETF to get. Berkshire reports its stock holdings each quarter in a 13F filing, with the most recent recording shares of 50 companies and 2 ETFs worth over $336 billion, along with $106 billion just in cash. Most of these are blue chip companies themselves, like Apple, Bank of America, and Chevron. Some of the stakes are controlling interest too, like 38% ownership of medical facilities leader DaVita, 26% ownership of Kraft Heinz, and one of the newest additions, a big stake of 20% in Occidental Petroleum. In fact, the smallest company in the portfolio here is RH, still at a $6.5 billion market cap. Most investors think Berkshire is just Warren Buffett's stock picks, but this is also wholly owns a huge list of companies across just about every sector. You've got insurance with Geico and Central States, transportation with BNSF Railway, real estate with Home Services and Clayton Homes, retail with Dairy Queen, Fruit of the Loom, Pampered Chef, and a list of others. It is hard to argue with the success of this business model, producing a 605% return over the last 20 years. That's over 10% annualized return and easily beating the overall market here with the S&P 500. And now with that insurance-heavy portfolio of owned companies, along with Buffett's value investing strategy, this stock should hold up really well during a recession. It's already beating the market by 12% so far this year, with shares lower by only 5%. This one is also easier to buy than the Berkshire A shares at over $424,000 each. They are the exact same investment. The B shares are just split regularly to make them a little more affordable for investors, but you're still going to want to use them on an investing app that allows fractional share investing, so you don't need to buy a full share if you don't want to. And just one analyst covering the stock here, with a target of $373 per share from UBS for a 32% upside, but this is one you'll want to hold forever. Click on the video to the right for the best index fund to buy right now and the power of being the market rather than trying to beat the market. Don't forget to join the Let's Talk community by tapping that subscribe button and clicking the bell notification.